So let's say somebody is a new home buyer in the last 2 years, 3 years even.
Mm-hmm.
Should they consider, and of course they have a 30-year mortgage, should they consider refinancing into a HELOC?
I would say for the most part, no. Now, there's two sides to the question. Should they consider refinancing that mortgage to a HELOC, like you're talking about a first lien? Depending on their financial situation, probably not. And the reason why I say depending on their financial situation, let's say somebody was just killing it, making good money compared to their expenses, then yeah, sure, convert everything to a home equity line of credit, especially when it's on a promo rate, because you could still compete with what mortgage rates were 2 and 3 years ago if you get a promo rate with a HELOC. And so if you are rate sensitive, emotionally rate sensitive, then fine, you can win that game too. But you could also win via your income, because time and balance is far more important than what the interest rate is. But someone who is rate sensitive, let's say they're making, $7 grand a month and spending $4,500 in expenses, I don't think so. Because if you got a mortgage 2 or 3 years ago, you probably got something in the 3s, if not the 2s. And I don't know that those rates are ever coming back. So why not get a second lien position home equity line of credit, unlock access to that capital, and then play the exact same game we teach, and then chunk that HELOC onto the mortgage. Now you're protected with the low rate mortgage over here, and then you've got potentially a variable rate home equity line of credit over here that you're executing the cash flow strategy on. As you pay it off, you dump it onto the mortgage. Then you rinse and repeat. And that's still far faster than paying extra on your mortgage. Paying extra on your mortgage is the second slowest way to pay off debt. The slowest, making your payment. Paying extra, second slowest. Then we get into the chunking method, and then obviously the holy grail is let's get a 1.99, 2.99, 3.99, whatever it is, home equity line of credit in first lien position and eviscerate all debt.
What's the difference between a first lien and a second lien? What are the different types?
Yeah. I'll start with second lien because most people understand second lien, because if I said, hey, you should entertain going out and getting a home equity line of credit without ever hearing anything else that I say, you're already assuming I have a mortgage and I'm getting a loan above and beyond my current mortgage, right? So people think of a home equity line of credit as advertised. How do banks advertise home equity lines of credit? Hey, are you looking for home improvements or debt consolidations? Then you should look at getting a home equity line of credit. And so that's a second lien position product. I honestly, and I hate to take credit for it, but I haven't experienced anyone else promoting first lien position home equity line of credit until we hit the scene. Because everybody else that was talking about this strategy, which is completely valid, this strategy I didn't come up with. It's awesome strategy. I'm glad I adopted it personally, 12, 13 years ago. But they were all quote unquote marketers. Maybe they got a real estate deal over here and they're looking for some kind of cool message to generate leads. And then once the leads come in, then they're like, oh, by the way, are you interested in buying some real estate? Something like that. Who knows? But they tend to be marketers. Up until we hit the scene, there was no other company out there, to my understanding, that were actual bankers. Maybe at one point, there was one company, 2 individuals that I think they did have a short stint in either the lending world or the banking world, but weren't quite promoting it the way that we promote it, or even design it the way that we design some of ours either. We have always been, and to this day still are, at least me, like I've mentioned before, I'm in a venture with a publicly traded bank up in Michigan. We're heavily ingrained in the lending and banking industry. So we took a look at it from a different approach. It's like, holy crap, what's preventing the HELOC from being in first lien position? So here's what first lien is, the one that most people don't know even exists. It's entirely refinancing your mortgage to a HELOC. And people think that they have to have obscene amounts of equity in order to do that. Let's say you owe $200,000 on a mortgage and you got a $400,000 property, then you have to go get a HELOC for that other $200,000 to pay off this $200,000. No, you could have a $400,000 property that you owe $360,000 on and refinance the entire $360,000 mortgage onto a home equity line of credit. It's a refinance. No one made a law or regulation that says when you refinance, it has to be from a mortgage to a mortgage. It can be from a mortgage to a home equity line of credit. Hence the name of the company, Replace Your Mortgage. It's just refinancing your existing mortgage and flipping it to a HELOC. And since that's the only debt that is a lien on your home, that becomes automatically a first lien position home equity line of credit. So there are a lot of examples where first lien makes sense for the right people. And there's definitely some, especially in this environment, where second lien makes more sense than a first lien. But we analyze those numbers and present those and say, hey, in first lien, this is what it would look like short-term and long-term. Second lien, this is what it looks like short-term and long-term. You know, here's the math. Which one do you want? And obviously we help guide them with that answer too. So hopefully that makes it clear between first and second lien, because it is very confusing. We take it for granted because we've always done this, but yeah, that's one of the top questions is what's the difference between a first lien and second lien?
How should someone decide the right type of HELOC for them?
Proper understanding of not only their own finances, but what is being offered in the marketplace. You know, I hate to be a broken record, but they're just so different. You know, you and I could sit here and prank call bankers, and we could get 10 on the phone. We're going to get 10 different answers, 10 different products. Now, does that mean, let's say out of those 10, we find one that makes the most sense for your situation? Does that mean it makes the most sense for my situation? No. My situation is entirely different than yours, good or bad. I mean, it's just different. We have different goals, just different aspirations. We have a different tolerance for risk. You know, maybe all you're looking at is becoming debt-free, and maybe I'm looking at, all right, I need a vessel to store cash that suppresses the amount of interest I pay, but at the same time, I want to tap into it periodically to use it to go buy another asset that's cash flowing. Yeah, my way has some risk. It depends on what I'm putting it into. You know, if I was putting it into Shiba or Dogecoin, and I'm not crapping on crypto, I'm just saying maybe there's no risk there. I just don't know enough about crypto to know what the risks are. To me, it seems risky because I don't know enough about it. Yeah. But, you know, one could easily say, just because I'm leveraging, mine's more risky than yours. But if I know what I'm doing and I'm getting into the right securitized cash flowing assets that generate monthly cash flow well above and beyond the debt load, well, then I'm going to get there faster than you because I leveraged and you didn't. You know, if this seems confusing, I promise you it's not once you understand it. We've taken mechanics, the hardest ones are lawyers and CPAs and financial planners. Everybody else has been a way easier to get them to the point of understanding that we're at. So if you're not a lawyer, you're not a CPA and a financial planner, then you're actually going to have an easier go at it than those folks. But if this, you know, speaks to you and you're like, you know what, I'd like to explore this, and that's all we're talking about, explore it, then just reach out to us, have a conversation. You know, worst case scenario, we'll walk away with some type of relationship. That's the worst case scenario. We're not going to put a gun to your head and say, pay us or else. That's not the way we roll. So yeah, worst case scenario, you walk away with a relationship and added value.